Welcome to our session for today. Our topic is franchise accounting based on IFRS number 15. Question number 1. What are the criteria to recognize initial franchise fee or continuing franchise fee as revenue? How do we allocate the transaction price to the performance obligations? Are we only limited to use the relative standalone selling prices? What are the different alternative methods to allocate the transaction price to the different performance obligations? Number 2. What is the difference between total revenues of the franchisor and the total revenues from the franchise fee? Where does the difference lie? Question number 3. Does IFRS number 15 prescribe accrual method only? How about installment method and cost recovery? Are we not allowed to use them under IFRS number 15? Question number 4. What is the treatment of out-of-pocket costs? Among the different out-of-pocket costs, such as the direct cost for continuing and initial services, the indirect cost for initial and continuing services, which among of them can be capitalized? When do you consider your direct cost for initial services as capitalizable? And when do you record that as an asset? Those are the questions that we will try to discover together. Please tune in so that you would know the answers to those questions. Welcome to my YouTube channel. This is Dr. DLC Ferrer. I would be your online teacher for today. The first topic is all about total revenues of the franchisor. What do you notice? How many items do we consider to compute the total revenues of the franchisor? Number 1, initial franchise fee. Number 2, continuing or contingent franchise fee revenue. Number 3, interest income. What did you notice? The interest income is included if it is all about the revenues of the franchisor. You would consider the different sources. I will discuss later what are the different criteria to recognize these revenues. And when do we fully recognize the initial franchise fee? Or should we only measure this based on the down payment and the present value? But please remember, the total revenues of the franchisor would include 3 components: the initial franchise fee, the continuing or contingent franchise fee, and number 3 is interest income. If you're going to compare this with total revenues from the franchise fee, what did you notice? If your exam would ask you a question, the total revenues from the franchise fee, this does not include your interest. Your interest income is only a result of the issuance of a promissory note. It's not basically based on the initial franchise fee and the services that the company would be providing to the franchisee. And that is your continuing franchise revenue. So we're able to answer one question with respect to the difference between the total revenues from the franchise fee and the total revenues of the franchisor. Let's talk about the different criteria to recognize revenue based on IFRS number 15. Number 1, initial franchise revenue. If you would be asked in your examination, when will you recognize initial franchise fee as revenue? The answer to that question is when the risks and rewards of ownership had been transferred from the seller to the buyer, when the seller does not have control any longer over the goods because the goods have been transferred to the buyer. The collectibility of the note is reasonably assured. The amounts of your revenues and costs can be reasonably measured. Those are the things that you have to take into account when to record your initial franchise fee as revenue. However, for examination purposes, like it's a multiple choice question, what are you going to look for is simply when the franchisor satisfies the performance obligation. That's very important. When the franchisor satisfies the performance obligation, if this statement is not given in a multiple choice, you may consider this second statement. When the franchisor transfers control over the operation of the franchisee, the word is control. And this one is all about satisfaction of performance obligation. The next question is, if the problem is silent, do we recognize initial franchise fee at a point in time or over time? So we will answer that question. If the problem says that the down payment represents fair value of the services already rendered, and the problem would not give you a refund period, you're going to use IFRS number 15. So ganun lang siya ka-basic. When a problem gives you an information about down payment, whether that is refundable or non-refundable, you are using the old standard, which is based on US GAAP. Take note that under IFRS number 15, we are only allowed to use accrual method. It means that when the collectibility of the note is reasonably assured, that's the time that you recognize revenue. You are not allowed anymore to use installment method and cost recovery under IFRS number 15. However, for examination purposes, if the examiner is using the old standard, you are going to use installment method or the cost recovery method. I'm gonna teach you later how to know if the problem uses the old standard. So tatandaan, under IFRS number 15, if the down payment represents the fair value of the services already, and the problem did not mention anything about the refund period, you're going to use accrual method. Everything is based on the performance obligation. When the satisfaction, there is a satisfaction of the performance obligation. Let's talk about number 2, which is contingent or continuing franchise fee. Take note that there are two conditions that should be met. In the absence of one, you are not going to recognize the contingent franchise fee yet. Number 1, sales of the franchisee already occurred. So normally, the problem would give you an amount of sales. So indicator na yon that a contingent franchise fee can be considered in the computation. The second criterion is when the performance obligation to which or all of the contingent franchise fees or sales-based royalties have been satisfied or partially satisfied. So these are the things that you're going to consider. A contingent franchise fee is considered as a variable consideration aside from the bonus. Take note that I would be also discussing on how to allocate your contingent franchise fee. Di bang alam natin that simply multiply the amount of sales by a certain percentage? Later, I'm gonna tell you that it's not only the basis to know of how much is the contingent franchise fee. It can also be allocated. But for examination purposes, if the problem is silent, just simply multiply the amount of sales by a certain percentage that gives you already your contingent franchise fee. Interest income based on passage of time. Using effective interest method, any discount on notes receivable or the unearned interest income should be derecognized or should be amortized on a piecemeal fashion. With that, you will be recognizing interest income. So there are three sources of revenues under IFRS number 15. Number one is the initial franchise fee. And the important words are satisfaction of performance obligation, as well as um, that there is a transfer of control to the franchisee. Number two is the contingent franchise fee. And what is important in contingent franchise fee is that the sales already occurred. Number three, you compute the interest based on the effective interest method. What is the measurement of franchise revenue recognized from the franchise agreement? For examination purposes, a multiple choice question, the best answer to that is the fair value of consideration received or receivable. If this statement is not given to you, the fair value is represented by the standalone selling prices. So you're going to allocate the transaction price to the performance obligation. The general rule to do it is in proportion to the relative standalone selling prices, except number one, allocating discounts, and allocating number two, allocating variable consideration. Take note that the discounts and variable consideration can be allocated also using the relative standalone selling prices. A discount or variable consideration should be allocated proportionately to all the performance obligations. It is, however, possible to only one or more, but not all, to the performance obligations. So it depends to the specific performance obligation. It depends on the relevance of these discounts and variable considerations to specific performance obligations. So this is very important, ha? Kapag may discount at saka variable consideration, for examination purposes, if the problem is silent, you don't have to allocate. But according to IFRS number 15, the problem would give you some indicators that you would also be allocating the discounts and variable consideration based on the relative standalone selling prices of the different performance obligations. Sometimes, this discount and variable consideration would only be for one or two, but not all, the performance obligations. Therefore, you would only allocate to those specific performance obligations. These are the alternative methods to allocate the transaction price to the different performance obligations. So what are these? Number one is what we call the adjusted market assessment approach. What do you mean by adjusted market assessment approach? This is simply the competitor's pricing. The price is based on what a customer would be willing to pay in the market. Number two is the expected cost plus a markup approach. So yung forecasted cost of satisfying the performance obligation, then adding an appropriate margin for the goods and services would be the basis to allocate the transaction price. Number three is the residual approach. Ang gagawin mo dyan is simply to have your total transaction price less the sum of the observable standalone selling prices. The residual amount is the basis to allocate the transaction price to the different performance obligations. I would be having a separate presentation to use different methods to allocate the transaction price. Take note that NRV method is not allowed under IFRS number 15. For multiple choice problem, if you're going to be asked which among the following items or methods that IFRS does not prescribe. Letter A, adjusted market assessment. Letter B, expected cost plus markup. Letter C, residual approach. And letter D, NRV method. The answer is D because you are not allowed to use the NRV method under IFRS number 15. The next discussion is all about the old standard. How would you know if the examiner uses the old standard? I'll be discussing this in our part 2 of the presentation. Please check the related link so that you would know when to use old standard.